So just the other day, I almost put in an offer on a rental property. And when I was deciding on whether to put an offer in or not, there was a couple of problems I noticed with the market overall that made me second guess this decision. And I eventually didn't put an offer on this property, but I did want to talk about some of those things that I did see. So in this video, let's discuss some of these problems that I saw, why they're happening, and what to look out for in the future to see when would be a good time to get into the real estate market. I went to an open house to this property that I was interested in buying. It was a bit of a fixer-upper and was on the market for about 6 days. And at the time of the open house, there was no offers on the property, which is a pretty abnormal thing to see for a fixer in this area. So I went to open house and I looked around the property and I noticed that there was really nothing abnormal with the property. There was a couple of cosmetic things that need to be addressed, but really it seemed like everything was in pretty good shape and pretty intact. All right, so the home was a little bit out of the price range that I was looking for, but I decided, why not? Let me just put an offer on it since there is no offers and it's already been a week. So when I got home, I started running the numbers on this property. So if you've been watching this channel for a while, you know that my favorite way to invest in real estate is to buy a property, fix it up, and then rent it out. And when I started running numbers on this property, I saw a massive issue. So I noticed that even if I was to put something like a 25% down payment on it, the property was still negatively cash flow about $1,600 a month. A negative cash flow in the area where I am, but typically it usually isn't that large. So that led me to my first concern with the real estate market as a whole. And because of that, I decided to check out on some other fixers and to see kind of what the cash flow looked like on these other properties. And I saw it again and again and again. It was like negative $1,600, negative $2,000 a month, negative $2,500 a month. So I noticed the same pattern over and over again. That really concerned me about the market because I've never really seen this in the entire time I've been investing in real estate. A common line of thinking in real estate investing is that the hardest part is to get a good deal. Well, then I thought to myself, okay, why happens if instead of me fixing up this property and then renting it out, why happens if I just fixed it up and then immediately sold it, or what we would just call flipping? And to do this, I looked into the comps. So I looked into some of the past sold homes from this summer. And it seemed like the price range that this would sell out back then, if it was completely fixed up, was around the $550 mark, which would mean that if I was to spend about $50K fixing it up, I'd probably net profit after holding costs and transaction costs, probably somewhere about $40,000 to $50,000. But what I saw when I looked at the current listings was very concerning. There was another home that was basically almost a model match to the fixer that I found. And that home was going for fixed up $500,000, which was 10% less than what the comps. And not only was it 10% less, but also that property was on the market for, at this point, over 40 days. Which, again, in this area, if a property is on the market for more than like 20, 30 days, that is very odd. So I figured that, okay, if the after repair value, the value of the property after I make all the repairs, is $500,000, I would essentially not be making a profit on this deal. And that's mainly the reason why I didn't write on this property, because you couldn't fix it and rent it out. You couldn't fix it and flip it. And also in a market where prices just dropped 10% in a matter of like 2 months, the last thing I want to be doing is flipping. And I don't have $1,600 a month to float the negative cash flow. So for me, I just had to walk away from the deal. So why is this all happening? Well, mainly it's due to interest rates. In the Fed's September summary of economic projections, where they predict where they think that certain parameters of the economy will be, like unemployment rate, GDP growth, as well as the Fed funds rate, they iterated two major beliefs. First, that the economy will perform well over the next couple of years, or at least better than what they previously expected in their June SEP. But they also predicted that they would have to keep rates higher due to the strength in the economy. And by the end of next year, they had only predicted about 100 basis points of rate cuts. And then in the end of 2025, they had only predicted another 100 basis points of rate cuts. And this was in stark contrast to what we saw in their June SEP, where they had shown that the Fed funds rate would actually be cut by 125 basis points by the end of 2024, and then another 100 basis points by the end of 2025. So 2025 stayed stable, but 2024 showed that there's actually going to be a process where they keep rates higher for longer. A popular trade on Wall Street recently has been to buy up treasuries with the ideal that the Fed will cut early in 2024. Because of what we saw in the SCP from the Fed, that kind of took a lot of steam of that belief out of the market, and it started to cause a lot of investors to start to sell off treasuries. And because of this sell-off, it pushed the 10-year treasury rates even higher. Well, what does the 10-year treasury rates have anything to do with mortgage rates, you might be asking? Well, the 10-year treasury has a loose correlation to mortgage rates. So the higher treasury rates go, typically the higher mortgage rates go as well, which puts pressure on buyers of real estate and starts to even price some buyers out of the market. And given the fact that the pre-start to school rush of real estate is basically over, it's causing a lot of near-term softness to the real estate market. And on top of it too, what we're starting to see is that inventory is relatively flat. Even though, yes, inventory is a lot lower than it was a year or two ago, it is relatively flat and it hasn't really moved very much. And given what I said about there being less buyers and inventory being flat, that usually ends up leading to softer home prices in the short term. And probably explains why I saw such a massive decrease in prices from the comps I was looking at from July and August to active listings that I'm seeing today in September. Also, with the Fed's SEP saying that the Fed is planning to keep rates higher for longer, that is causing less people to speculate on possible rate cuts in the near future. You know, there's a common saying in the real estate industry that you marry the home and you date the rate. And pretty much the ideal behind that is that, okay, just buy a home now, so then in 6 months to a year, you could refinance at a much lower rate. And that was a really strong belief at the beginning of this year. But now, as we start to see that the Fed is very serious about their higher for longer stance, it seems like you might be dating that rate for a lot longer than you expected to. And that even drives more buyers out of the market because you have people who say, oh yeah, I could deal with high rates for a year, but what happens if the Fed keeps rates high for 2 years? Well, then now, oh, I can't afford that. Then you end up having sellers who are forced to sell, or you end up having buyers who bought and then they're forced to sell later on, even though they may have just wanted to refinance to a lower rate. And this backs up a Wall Street Journal piece that I just read that stated that the Fed just could keep rates at the level it is now if the economy continues to do well. And they could just save the rate cuts for if the economy starts to turn sour and use it as a way to sort of stimulate the economy. But if the economy still functions at this rate level, the Fed is not really motivated to cut rates anytime soon. And I think personally that this is a very fair argument. If we don't get any pain and the rates are at 5%, why cut it? This has kind of led me to a point where I think I'm going to be sitting out the real estate market this year. But I do think that there are two exceptions on buying real estate. And one of them is if you're buying the deal completely in cash or you're going to put down a huge down payment. And I'm thinking about maybe somewhere like 40% plus down. If you do put that amount down, at least from what I've noticed in my area, you would still probably have a negative cash flow, but you just won't have such a severe negative cash flow as what I stated earlier. And you won't have the risk of possibly the Fed keeping rates higher for longer and you not having the ability to refinance to a lower rate. But also by buying real estate in cash, something else that you have to consider is the other investment opportunities you might have. You know, generally speaking with real estate, the more cash you put down, the less of a cash on cash return you get. So if you do consider going down this route, I would tell you to make sure you do the math and make sure that it makes sense for you, especially if you have different options on ways you can invest your money. For me personally, I don't have the cash to buy a property 100% in cash, or even 50% for that matter. So that is kind of out of the question for me. Another exception to this, at least in my opinion, is if you're buying a home for yourself to live in or for your family. You know, I did say that buyers are starting to leave the market and inventory is flat. Well, one of the beauties about having buyers leave the market is that if you're someone and you're looking, let's say you have a family with 3 kids and you're about to have maybe a 4th kid and you live in a 3-bedroom home, well, this might be a good market for you to buy if you're picky and you want a 4-bedroom home with a certain size yard in a certain neighborhood. These markets where there's less buyers might actually give you a leg up looking for that specific home you're looking for. Generally speaking, my rule of thumb has always been if you're buying a home for yourself, you should really be more concerned making sure that the home is functional for you and not just looking for something that you can make money off of. Well, and if you're buying an investment property, which in my case, that's what I would be doing, it's a much different story. And another thing as well is that if you're buying a home as a primary residence, who knows? There's a chance that the prices could stay elevated or even move up even more. So the last thing I would want to do is have you wait on the sideline and have you try to wait out the market only for the market to continue to go up and you eventually get priced out. So those are the major exceptions that I would really put on avoiding real estate as a whole right now. So I'm always passively looking for investment, no matter what. No matter even if I realize that I'm priced out or whatever, I'm always looking. And I think that if you are someone who wants to be a real estate investor, you should always be looking for deals because you just never know what could happen, what deals could work, what deals can't work. So you should always be in the motion of looking. But really what I'll be looking out for in 2024 is 2 major things. The first thing is pressure on the economy. And mostly what I'll be targeting on is the unemployment rate. We have started to see the unemployment rate start to trend up. But if that trend continues or it picks up some steam, I think the Fed may consider cutting rates faster. And one thing about the unemployment rate is that it is a lagging indicator for a recession. So if we start to see it move up quickly, that's a really bad sign for the Fed and for just the economy as a whole. So I'll be really watching out for those job reports, especially ones that we get from the Bureau of Labor Statistics. Generally speaking, those tend to be a little bit more accurate than like the ADP reports. I know on this channel I usually cover both of them, but I definitely would really pay attention to those BLS job reports. So another thing I'm going to be looking at is the relationship between total active listings and months supply of inventory. And this indicates if buyers or sellers are leaving or are coming into the real estate market. It is also a leading indicator of price direction. So an easy way to do this is that you could go on the Redfin data center and you look at active listings versus months of supply. If the active listings are flat and the month of supplies is trending up, this means that buyers are leaving the market, which probably means that prices are going to start trending down. And this is currently the trend nationwide. But if you see months of supply stabilize and you see active listings start to trend down, that means that sellers and buyers are both leaving at the same time. If you start to see month of supply number start to fall, but you start to see active listings also fall as well, that probably means that buyers are actually coming back into the market. So pretty much that's why I'm not buying real estate this year. And I'll probably look more to 2024 to buy. Really for me, I always like to say, invest in real estate's a long-term game. So it's better that you wait and you make sure that you can hold on to the property, or you can at least sell the property under your own terms and you're not selling it as a distressed seller. But that's basically all I got for you guys. Thank you so much for watching. As always, please like, share, and subscribe. And I'll see you in the next video. Peace.